You say three worst words
Right.
in your world is, I missed it.
Right.
Can you explain?
Sure. Well, the classic cliche for 100 years in value investing has been the four most dangerous words in investing are, this time is different. I've taken a little twist on that because those are the four most dangerous words, but the three most dangerous words are, I missed it. And what that means is you look at a stock, if you're a stock picker, or you look at a fund, if you're trying to pick a good manager, and you look at a stock that's maybe doubled in the past year. And as a value investor, the typical momentum, unsophisticated, non-value investor likes to pile into stocks that have doubled in the past year. But for a real value investor, I like to do the opposite. I like buying stocks that are down 50% in the past year. That's where I make my money as a value investor, is buying things that are out of favor and betting on turnarounds, right? So it's very difficult for me emotionally to, somebody tells me about a company or I start reading about it and I look at it and then I look at the stock chart and it's doubled in the past year, and instinctively I say to myself, even subconsciously, I say, I missed it, and I just stop doing work on it. It's just like, I don't want to buy a stock because it's doubled in the past year. And that's not rational. The only thing that matters to me today is I can buy this stock today at this price, and is that price a substantial discount to intrinsic value? And if the answer is yes, I should buy it. So the best example I can give you of this is how many people knew Warren Buffett was a genius, but looked at the stock and the A shares were $10,000 a share, and 10 years earlier they were $1,000 a share. So the stock had gone up 10 times in the previous 10 years. And so they said, you know what, I missed it. Everybody knows Warren Buffett's a really smart guy, and I'm not going to buy the stock at $10,000 a share. And you know what? Today the stock's at $160,000 a share. It wasn't too late. So sometimes you can, a company or a fund or an investment manager is really that good, and the intrinsic value is steadily growing, and even after the stocks run up, it still might be cheap. That said, I do not recommend as an investment strategy buying into things that have doubled in the past year. That's generally momentum chasing, and it will end badly if you just chase performance. But the point is it shouldn't matter whether the stock has been down 50% or up 100% in the past 12 months. You should wipe your mind clear of what happened in the past and just simply analyze a stock, analyze a business at today's price, and decide whether it's cheap.
You still own Berkshire Hathaway?
Yes.
One of your top 10?
Yes,
would
my
you buy
second
it today?
largest position today. This is the only stock I'll admit that I do allow some emotion to creep in to my analysis, because Warren Buffett and Charlie Munger are really my mentors in this business. I learned value investing from them through their writings, through attending their annual meetings. The underlying company, Berkshire Hathaway, is going gangbusters. They just reported an incredible quarter. And so every time the stock runs up a bunch, I redo my calculation of intrinsic value, and intrinsic value is going up as well. So the answer for Berkshire is the stock's around $160,000 per A share. My estimate of intrinsic value is approaching $200,000 a share at this point. So I would say Berkshire today is, call it an 85-cent dollar, probably. It's about a 15% discount to intrinsic value. But I think Berkshire is an incredibly safe and sound business. I don't think you're going to get blindsided by any derivatives or something, that would be a risk with other insurance companies. And I think there's always a chance that Warren Buffett finds another big deal to do that really juices intrinsic value beyond the 10% growth of just the operating businesses of Berkshire growing every year. So I would call it a safe, nicely growing, but not incredibly cheap stock at this point. So I think it's a good foundation for a conservative investor. I think if my choice was buy the S&P 500 index fund and hold it for the next 5 or 10 years, or buy Berkshire, I think odds are 80 to 90% that you will do better if you just sit there and hold Berkshire and forget about it. But it's not as cheap as it was. The stock's had a nice run. A lot of stocks have had nice runs recently. But don't fall into the I missed it trap with this one.